Good evening, everyone. Today, I'm extremely glad to have Nick Roos with us. He's a partner in ICE Miller's litigation group. He concentrates his practice on insurance coverage, disputes, risk management, and commercial litigation. Nick regularly advises clients in insurance coverage matters, managing claims, and advocating policy construction that maximizes insurance recovery. As part of his risk management practice, Nick also assists clients with data protection and privacy matters. Today, he will be talking about the role of cyber insurance in security and risk management.
Thank you. So as he mentioned, I'm an attorney and I'm in the litigation group, and you know, I came up as a litigator, but I've always kind of done insurance law. When you practice in insurance coverage law, you know, there's two parts to it. You're handling claims after events occur, trying to help your clients get recovery from their insurance policies, and they're also helping clients procure insurance. And you know, that process, it's easy to do the former because every client wants to get recovery when they have something happen. The former is a little trickier because you're asking clients to pay for something that they don't know they need yet. And in this space, data security, privacy, information security has kind of been the exception to the rule. This is one place where clients are really, really interested in talking about insurance. It's kind of become this buzzword, and it's something I spend a lot of time talking about, a lot of time thinking about, and frankly, a lot of time working with clients on. And I like to think that I make insurance kind of fun, in that I'm kind of passionate about it. And so I love talking about this stuff, and so I'm going to kind of take you through the world of cyber insurance and how it fits into information security and the risk analysis process, and really what it looks like. But I'd encourage, you know, if you have any questions as we're talking about this, you know, don't hesitate. I know everybody says that, but I really mean it. You know, if you see something, you got a question, ask me, because like I said, I love talking about this stuff, and I'm happy to kind of take questions as we go. As I mentioned a minute ago, you know, it's kind of become this buzzword, cyber insurance. It is a big deal for a couple of reasons, both on the supply side and on the demand side. It's become this big deal because it's in the news a lot. You're reading about, you know, cyber crime, data breaches. You know, it's unavoidable. I'm sure you guys probably get tired of hearing about it just as much as everyone else does. But that's, you know, manifests itself in corporate boardrooms, in presidents of small businesses, risk management folks, you know, making this a priority. And so, you know, it's a question they're asked constantly by their customers, by their vendors, by their employees. What are we doing in this space? On the flip side, and the kind of what I'll call the supply side, you have the insurance industry, and I will tell you that 20 years ago there was no such thing as cyber insurance. It just didn't exist for the obvious reasons, and it kind of had this slow growth. It kind of started to exist, and then, you know, all of a sudden there was just this explosion in the last 5 to 7 years. So you went from a space, a market that didn't exist for insurance companies, to what's going to be few $1 billion of premiums in the next couple of years. And so there's been kind of this arms race. Everyone wants their piece of the pie. It's been a long time since a new category of insurance has just appeared out of the ether. I mean, you've got, you know, your traditional lines of insurance that all you guys have heard of. 30, 40 years ago, the idea of what was called directors and officers insurance came up, and that was a big thing, and everyone raced to the market. And since then, this has been the first new big thing. You know, why is it a big thing? I mean, like I said, it's the supply, the demand, but it's also the reality, and it's kind of what I'm showing in this slide here. You know, I was told this is kind of a diverse group. You know, some of you are in computer science, some of you are not, some of you are interested in information security, some of you are just doing this stuff for fun. But the fact of the matter is there's been this realization that no matter what you do, you're still going to have, you know, what this comic strip calls Dave. You're going to have human error, and there's going to be, you know, this event. You know, and for some businesses, companies, they're going to have events and it's going to be, $100,000. Some they're going to have events and it's going to be $1 million, and some they're going to have events and it'll put them out of business. But then there's some that have gone through this process and they've got the right insurance in place, and it will just be an inconvenience, but ultimately there won't be a huge cost associated with it. And so to kind of distinguish, the stuff on the right, firewalls, encryptions, that is risk avoidance. What insurance is, it's risk transfer. It's saying, hey, I'm going to do my best, but ultimately I want to transfer this risk to somebody else. And the reality is, no matter how much risk avoidance you do, there's risk left on the table. And so this is the mechanism to transfer it. And so it is part of the information security, the data security conversation from the small business to the Fortune 500 company. You don't have to take my word for it really either. I like to put this up because this is SEC guidance, right? The SEC doesn't have a formal regulation with respect to what I'll call cybersecurity, although I know that word gets overused, but they use it here, so I'll use it here as well. And the SEC is saying, hey, when you're investing in a company, we think that cybersecurity is now important enough that companies need to be telling investors, this is what we're doing about cybersecurity. And you'll see these different things. Hey, we think they should disclose A and B and C and D. And the last one on there is the description of relevant insurance coverage. So even the SEC, who has no stake in this game, they're not selling insurance. They're saying, hey, if you're evaluating the cybersecurity of the company, and we're going to list 5 things, one of those considerations, one part of that risk analysis is the insurance that they're carrying. And so this is an unavoidable part of kind of the total, security process, the total risk process. And so I guess that begs the question, why should you care? And I think, I guess I don't have a total sense of how many of you, are going to be in information security as your career or are going to be doing computer science. But I'll tell you a few things. There is effective insurance procurement and there's ineffective insurance procurement. And there's a lot more of the latter than there is of the former. This has become a check the box exercise. Businesses know, I have to have this, everyone wants to know, do you have your cyber insurance? Did you put a policy in place? And so, they go talk to the broker, they say, hey, I want a policy. They get a policy off the shelf, they pay the premium, and they can say to their board or their investors or their partners, I got it, we've got cyber insurance policy. The reality is this is I think a lot of you probably know, getting a handle on your own network infrastructure, your own system infrastructure is incredibly complicated. And then you combine that with the complexities that are inherent in an insurance policy. I mean, go read your auto policy and you'll see how cryptic insurance policies are written. So you've got one person that speaks the insurance language, and then you've got somebody, a HR person, a general counsel, who doesn't speak the technology language. And they're trying to come up and pick the right policy, and that doesn't work. And so it's people that understand the technology. If any of you are working in IT, IS, that is somebody that needs to be part of this conversation. And so I think it's important to understand the framework, understand what this marketplace looks like, understand what is covered and what they're trying to achieve and what they're not trying to achieve, because it puts you in that unique position to know, hey, as a business, when we're doing this process, this is what we need to be looking for in insurance policies. This is what is out there, because a lot of times that's the biggest problem is, you only have a lens into the insurance world based on what your business's agent or broker shares with you or is willing to tell you. And so I think it's important in this space to understand, what this market looks like. The other reason that I think, folks in the technology space need to care about insurance is that piece of pie, that portion of risk that's being left on the table. It's increasing in size to a certain extent. For all the news, for all of the attention that this topic gets, businesses are not seeing the collateral damage that you'd believe. There's a Poneman Institute study that says when there's a data breach, it costs $200 per person. That's pretty much been debunked, and that the reality is data breaches aren't that expensive. And for most companies, when they have an event right now, it's kind of been a blip. And so it's hard to convince businesses to make real investments beyond a certain point, beyond a certain dollar figure in information security. They'd rather leave some of that risk on the table and then transfer it through insurance. And the byproduct of that is insurance companies increasingly have a seat at the table in kind of this larger discussion of what are the minimum standards. So what are the standard policy and practices that should be out there? And whether you realize it or not, insurance companies are a big driver in setting those standards, because ultimately it's their risk, and so they have probably the biggest vested interest in seeing this through. So again, I think it's helpful if you're going to work in that sector to understand what cyber insurance is and kind of how it plays a role. So anytime you have a conversation about insurance, I think it's important to understand the difference between first-party insurance and third-party insurance. And so the easiest example is to think about your auto insurance. The first-party insurance that you have, that is the comprehensive coverage on your car, right? That is, there was a hailstorm or some kid was walking down the alley and broke my mirror off. I have something. I've incurred loss myself, costs myself, and I would like the insurance company to reimburse me. That's first-party insurance. So it's on your homeowner's policy, it's the part that covers hail damage to your roof. Third-party insurance, it's the idea of something happened, it's my fault, something happened to somebody else, and that person's making a demand on me. That third party is making a demand on me, and I want the insurance company to pay that person. So that's the liability portion of your auto policy, right? That's the guy you rear-ended. That's on your homeowner's policy. It's the person that slips and falls in the lawn. And when we talk about the different types of cyber insurance in a minute, you'll see they fall into the same categories. You'll have stuff like network interruptions or data restoration costs that you're incurring yourself. That's first-party stuff. Then you've got events where data breach is a perfect example. You got some first-party costs, but you have someone suing you for losing their trade secrets or suing you for losing their social security number. Because I can promise you, after every data breach you read about, there are lawyers filing a class action suit, whether it's winnable or not. And so that's somebody else. So there's a third party and a first party component. Historically, if you were a business, your first party insurance was covered under something called a CGL policy, and it still is. I mean, your third party insurance, a CGL policy, commercial general liability policy. That's what covers Kroger if you fall inside the Kroger, or what's covered to provides products liability coverage. For a while, there were some inroads on the CGL, and folks tried to put technology-related liabilities into the CGL policy because it wasn't really written with this stuff in mind. There's an organization called the ISO, and in my world, the ISO stands for Insurance Services Organization. I realize there's another ISO that you guys maybe deal with more often, but the ISO drafted the current version of the CGL in the 60s, and it gets tweaked every 4, 5, 6 years, but it's a word here, a word there. Otherwise, it's just this same policy. And so there were some inroads where insureds started getting coverage out of their CGL policy, and then eventually the insurers said enough, and in 2014, that was revised to make abundantly clear that these kinds of technology-related losses that we're going to talk about as being covered under cyber policies, they're out the door. Same, they're not part of the policy. There's unimpeachable language now included in the CGL policy. Same thing on the first party side. It was traditionally covered under what was called a property policy, a business property policy, a commercial property policy. Same thing. Standard form. For a while, there was kind of these tortured attempts to bring technology events within the property policy. But the thing is, it always required a physical loss. So there's kind of these funny court opinions from the late 90s where judges are trying to talk about electrons moving to try and imply that there's been some physical loss, like a hurricane, but it wasn't. And so eventually, same thing. They wrote it out of the property policy. And so you write it out, they say they were just trying to live up to expectations, but what do you know, they created this multi-billion-dollar market, because once it was written out, and the answer was specialty insurance. And specialty insurance is once you get away from those things, your auto, the CGL, the property. This is for a very specialized risk. That other stuff is written on kind of an all-risk basis. It says, we'll cover you for anything that causes bodily injury. Well, this is specialty insurance. It's written for a very specific purpose. And what happened is that ISO, that organization that I mentioned a minute ago, they started out, they tried to draft their own kind of cybersecurity policy, and nobody liked it. It was a little too basic, and you didn't have the 50, 60 years of expectations that had been created, say, like under a CGL policy. Because one thing about using the same policy for 50 or 60 years, every word in that policy has been defined by 10 different courts, has been the subject of disputes. I mean, you could tell me about any kind of loss, and I could tell you without looking at a business's policy whether it's going to be covered or not, because I know what a CGL policy looks like. Here, once the ISO policy got kind of tossed out the door, every insurer started writing their own policy. And so you kind of had this huge smattering of insurance policies. If you go to AIG's website right now, you go to their technology page, you'll see they're offering 4 different policies it's hard to tell the difference even between their own 4 policies. And then you take that across the entire insurance market and add in the fact that everyone's competing for this pie, this huge new pie, and you just have policy after policy being cranked out. You combine that with the difficulty in terminology. Everyone knows what a bodily injury is, and we can define it, and insurers can define it, but there's no uniform terminology. I mean, there are in certain instances, but it's much more difficult to write in succinct languages and describe the type of events that are going to lead to technology-related losses, to lead to cyber losses. And so what you end up with is these cyber policies and the insuring agreement, the part that says this is what we're going to cover. It'll be a sentence, and it'll just say, we provide coverage for loss arising from a security event. And security event will be in bold, which means it's defined elsewhere in the policy. So you turn 17 pages into the policy and you find the definition of security event. It'll be 2 sentences, but then it'll have 9 bolded words in it. And so then you go find the definition of those 9 bolded words. And pretty soon it's like a computer program. I mean, you're doing all these substitutions and replacements to figure out what that first sentence meant. And you try and do that across 12, 14, 20 policies, it starts to get really hard to compare this stuff. So you end up with kind of this wild, wild west. And that goes back to that point I raised at the beginning of, people that are computer programs, that are information security. They have to be part of this conversation once you're in the private sector or your university, wherever, because you're the ones that can say, all right, what they're describing there as a security event, once we take it down to the nubs and see what they're talking about, that's not our risk. Our risk is this. And that's described in that 3rd policy you showed me, not the first one, not the second one. So there's kind of this, there's both opportunity and risk because of this smattering of policies. The risk is you're going to buy a policy and it's not going to cover any of the risks that your organization actually has. On the flip side, there's this opportunity where if you know your risks and know how to read these policies and you take the time to read them and analyze them, a lot of times you can get coverage for risks that the insurance company isn't really even charging you a premium for, because there's this asymmetry of information, and we'll talk about that in a minute as being one of the underwriting problems. You know your system. It's really hard for an insurance company to come in and wrap their heads around your infrastructure. I mean, they can do it, but are they going to put the man hours in? I mean, at a certain point, it's not worth the premium dollars for them to come in and sit next to your CISO and say, now show me this, now show me that. And so there's this information asymmetry that can be good, it can be bad, but it's something that if the people in this room, for instance, are involved in the process, it's an advantage, actually, to organizations. So this little chart here, I use this as kind of the layout of what the marketplace looks like here. And I want to kind of talk through these different categories so you get an idea of what's being covered and how it's being covered. And again, like I said, this isn't uniform, so I like to make them spin just to kind of illustrate the point that every policy isn't going to be organized this way. Sometimes you have to buy a first-party policy and a third-party policy. Sometimes it's one policy combining all of these coverages. Sometimes this is 8 different policies. On a couple slides ago, that little checkbox there, that's from an actual insurance application, and they want you to check those boxes. And then the policy is like 600 pages long, and you have to go back to that first page, and you have to go and match up the coverage parts with the boxes that are checked. So it's kind of this Chinese food menu approach. And so, but still, when you get down to the core, they're all selling versions of these same basic coverages. So third-party coverages, you kind of see tech E&O, network security, and data breach. And data breach, I kind of have straddling the two, and we'll talk about that in just a second. There's overlap here. When we talk about technology E&O, and I won't belabor, any of these too long because that can get a little boring, but technology E&O, the E&O is errors and omissions. So technology E&O, that is your technological products, your technological services. So if you're in the business of writing software and your software malfunctions and it causes a customer or your customer's customer a loss, that's technology E&O. You made an error and omission in the actual services you were providing as a provider of technology services that caused the loss to a third party, because again, this is a third party coverage. And so, yeah, it's obvious that, somebody that actually provides hardware and software is going to have this. But, increasingly, every business has some technology facing portion of their business, whether it's something as simple as a website or an app. So everybody carries or should carry some form of technology E&O for that portion of their business, because I can tell you that's not going to be covered under their other errors and omissions or liability type insurance. On the other side, we'll skip network security for a minute. You've got data breach. And so again, there's been some breach. You've lost socials, you've lost medical records, you've lost trade secrets. Sometimes it's even more innocuous. It's not something that is independently confidential, but you have an agreement with a customer that you're going to hold their information confidential. It can be, just customer lists. It can be, sales data, stuff that has a value in the economic marketplace but wouldn't be considered traditionally confidential. It's not a social. Yeah, go ahead.
How does data policy, but then separately, how does that work with SEC filings? Because, if you're saying I have damages because I'm getting sued, you have to also then file, if you're a public company, saying, we've lost this much. Do companies get in weird positions like that?
Sure. There's always a tension when there's ongoing litigation, and because you have to make a determination as to whether ongoing litigation is material. But here, when you're talking about a data breach, there's actually 2 cost components. You have the potentiality of a class action lawsuit, which is an actual piece of litigation. And that you're doing this materiality test. Is this because a company like Sony is being sued at any given time, in multiple iterations in multiple places. So they're always disclosing, hey, as part of our business, we have litigation that's ongoing. If something is going to be huge, something that is going to make a material impact on their balance sheets, they're going to disclose that. The other cost component that may end up in something like an SEC filing, and certainly is going to show up in a company's books, is when you have the internal costs for the data breach. And as I said, it kind of straddles, because the third party cost of the person suing you. The first party costs are things like, the actual cost of maintaining a call center, the cost of providing all that credit monitoring, the reputational harm. Believe it or not, you can get coverage for reputational harm. Hiring PR folks, complying with regulatory investigations, because you're going to have, depending on what kind of entity you are, you're going to have the FTC or state's attorney general coming after you and asking questions. So you really have 2 different costs. And whether it ends up in an SEC filing, yeah, that stuff happens. It really depends on how material it is. you can get into more complex issues when you're talking about, criminal activity and there's a criminal investigation. Sometimes, even notifying customers can be delayed if law enforcement says, look, we don't want you to tell anyone that this is happening because this is, there's an ongoing investigation. So there's some safe harbors there, but it's definitely something that can show up. And on the issue of the class action, what's interesting there is there's kind of been this changing landscape. At first there was this idea, hey, if I lose your social security number, have you really been harmed? I gave you credit monitoring. What are your damages? And courts at first kind of made this analogy to the medical device and pharmaceutical industry law, which had said for a long time, at least in this part of the country, that if the only thing you took a drug and you had no manifesting, symptoms, these side effects, just kind of being more aware that you should keep an eye out for them, are you really damaged? And the answer was no. And so there was kind of this analogy like, hey, worrying that your identity might be stolen, that's not a damage. And so there's no class action. That's eroded in the last couple of years. And some lawyers have made some inroads saying, you know what? It's confidential information, and it causes people emotional distress to know that they've been compromised, and so we're going to let some of these class actions move forward. And so I think we're going to see more and more companies evaluating those and saying, this is a material event. We do have real skin in the game. This class action could be very expensive to defend or ultimately settle or pay a judgment on. The kind of middle one there is network security. And this kind of, it fits in between because it's when you have, I'll use the term security event, when you have a security event, but it's not a data breach. You didn't lose something, nor was it the technology-facing part of your business, but there's been some network event, some security event that causes loss to a customer or a vendor, or sometimes even just a totally anonymous third party. This is folks get sued because they had weak network security and their system was used as part of launching a DDoS attack. Or folks get sued because they were the part of a compromise that ended up pushing malicious code to a bunch of other computers or a bunch of their customers or a bunch of their vendors. It wasn't the technology services they were providing. It was just part of their infrastructure. But it was a security event that caused losses to these third parties. And the idea is, hey, you were negligent. It was your fault that my system went down, or I had to spend all this money on data restoration. So that's this idea of network security, and so it kind of fits in between. The other side is the first party coverages, and we talked about the data breach one a second ago, but I like to highlight it because it's the one that people talk about the most. We're finding increasingly it doesn't need to be the biggest concern because the idea of a data breach has kind of been commoditized, the response process. Everyone has gotten so many data breach notices that the response rate that we see on credit monitoring is down to like 5%. You offer somebody free credit monitoring now, they've already got it from so many other places that they don't even take you up on the offer anymore. So those costs are going down. Same thing. There's companies that now all they do is run call centers to answer questions about data breaches, send out the letters. And so it's been commoditized where it's getting pretty cheap per person. But it's still something that you hear about a lot. And so, I put this up here, just because this is the question that I get the most from clients about their cyber liability insurance is, what do I care about on the data breach side? And so you'll see these are the things that I'm always looking for here. One thing that I think you guys could probably appreciate, the second one on there, forensic investigations costs. We found that is the most expensive component of this. It's more expensive than the lawyers. It's more expensive than the actual notification. Sometimes you got a breach and it's going to end up that there was 14 medical records involved, but you've paid somebody a lot of money to figure out that it was only 14 medical records. And that can get into six figures before you know it. And so that's kind of priority number one when you're talking about breach response. It's not the cost to send out the letters. It's not the cost of the lawyers. It's the cost to bring in good forensics people that can make this determination. Was there even really a breach? And how big or how small was it? Nobody likes to, despite what I'm telling you about the cost, nobody likes to over-notice. And so Nobody wants to send something to 6,000 patients if there's only 15 affected. P.F. Chang's, they raced out of the gate. They had a breach of their payment system. They raced out of the gate and they over-notified. And then it turned out that the breach was only about a quarter of the size that they thought. Well, what ended up happening? Well, MasterCard and Visa and the issuing banks, they had to replace all those cards. Well, they said to P.F. Chang's, we want $50 for every one of those cards we had to replace, and they had to replace 60,000 instead of 15,000. So there is this priority of let's do this right the first time. That's an extreme example, but when you start to talk about smaller businesses, just the reputational effect of having to notify, 600 customers, you're a small mortgage broker. You don't want every customer you ever originated a mortgage for to know that, you had this event. And so there's this idea of, hey, if I've got coverage and I can bring in somebody and pay them money to figure out what the real scope of this was, because you can always default to tell everybody that's ever been in your system, but you want the right answer there. A couple other ones that are interesting, data in the hands of third parties. Insurance companies have gotten better at this. There was a time where this was almost had reached a crisis level because there was so much cloud computing, and there continues to be, and the carriers were still defining computer networks and data stored on computer networks, and that was defined on kind of the stuff in your own building. And that wasn't workable, and they've gotten better at that. But it's one of these things you have to look for in these policies, because a lot of stuff isn't stored on your own system, and ultimately you're legally responsible when you have a breach that affects data you took in. And so even if it was somebody else's fault, it was some cloud provider, some third party, and there's been this event because they had an issue, you're still responsible, so you want to make sure this coverage extends that far. The other one I like to point out is exclusions and retroactive dates, because this is where the real meat is. You get into these exclusions in the back of an insurance policy, read them in your auto or your homeowner, and you'll see it's a pretty long list. And these cyber policies, they'll go on for pages. And on the data breach, this is one from a policy that a client showed me a few months ago. And keep in mind, this is a data breach policy. And you read the things, it says, regardless of other events or cause of contributing concurrently. So if any one of these things was true, they weren't going to provide you with coverage for your data breach. You look at that stuff, it's all ambiguous, broad language. It'd be hard to come up with a data breach scenario that wouldn't fall within one of these exclusions. And so again, it's this critical reading of, let's not buy illusory insurance coverage. And if you went and talked to the agent that's selling this on behalf of, I won't say what insurer it is, they'd say, oh, they don't mean it like that. They're just trying to take some things off the edges. But that's fine to say that up front, but good luck when you have a claim, because the way insurance works, there's underwriting and there's claims. And the people that are writing and selling the policies are not the same people that are reading them when it comes time to actually submit your claim and try and get paid. And so again, it's illustrative of kind of the problems in terminology. I mean, if you saw an insurance policy like this, you would want to run as far away as you could. Yeah.
I the previous and one use case scenario which falls under item 5. There are popular antiviruses.
I'm sorry, the link that you're using is acting up. Do you mind using maybe one next to that?
Yeah, I was just saying that several popular antiviruses, they have known vulnerabilities. So if I use those antiviruses in my company infrastructure, and then data is lost and my business is stopped, item number 5 says defects of software supplied by a third party.
No
is
coverage.
no coverage. And
Yeah.
antivirus manufacturer will tell me, hey, read the license. It says, like, we don't reimburse any damage, or maximum amount to be reimbursed is like
$100.
$10,000.
A lot of times they're the price of the product. They'll say, we'll give you your $49.99 back. Oh. But yeah, no, I mean, like I said, it's hard to come up with. If there hasn't been a defect in some third-party piece of software, or there wasn't you weren't using some obsolete, hardware or software, or you didn't fail to ensure that your computer system is protected to industry standards, whatever that means, it's not even a defined term. If none of those were true, you wouldn't have had the data breach in the first place, unless you were literally doing it on purpose. And so, it's just, again, it's terrible language, but it's exhibit number one as to why you have to read these kind of things, and the people that understand what the risks are have to read these things with the folks that are actually procuring them. The first party coverage is the other big category is computer crime, and we have seen that this has become a bigger deal. This is where our clients are underinsured, and this is where they have huge losses on this first party computer crime stuff. And I think that the ideas there are pretty self-explanatory. Data restoration, network interruption, and extortion. And there's coverages that are available just for kind of negligent and inadvertent events, and there are coverages that are available for malicious events where somebody is, intentionally attacking your network and interrupting your business. But those are two, data restoration, network interruption, depending on the scale and the size of your business, can be incredibly complicated, incredibly expensive, and is sometimes very difficult to compensate. I mean, you don't know what you've lost by being down for 3 days. You don't know what kind of customers were coming through. And you get this business interruption insurance that's supposed to compensate for that, but even that sometimes can be insufficient. Extortion is a really, really interesting one. So we have had this happen to clients with increasing regularity over the last 9 months. And talking to the FBI and talking to our clients and the security consultants that we deal with and the forensics folks, it seems like what's happened is there's become this efficient market on the dark web, right? And so it used to be that when you had an intrusion and people would go after socials, they'd go after financial records because they had a value and they knew they could just go sell them and kind of flip them over. Well, those values have plummeted because there's so many socials available, there's so many credit card numbers available for sale. So now what kind of happens is what I'll call the interloper. He gets into your system. He just takes whatever he can find because he doesn't know what it's worth. But like I said, there's this efficient market on the dark web where he comes back and he says, hey, I got these files from a company that manufactures widgets. Anybody interested? And then people come and he gives them a little preview and they say, you know what, I can do something with that. I'll give you X dollars. So he didn't go in saying, this is valuable. He took what he could and he puts it on the market. And that's caused big headaches for folks because all of a sudden, you've got schematics that are lost. Like I said, you've got customer lists and these folks show up and you get an email from one of these dark web email servers that says, I'm going to send your customer lists to your biggest competitor if you don't give me, and they're smart. They don't ask, it's not Dr. Evil. They don't ask for $1 billion. They say, I want, 30 Bitcoin. And so it's a small enough number that the business could pay it. But, or at least there's a conversation about, should we just pay it? But do you trust this guy? In conversations with the FBI, they'll never tell you do it or don't do it. But, if you get them in a weak moment, they'll say, frankly, most of these guys are pretty honorable about this. You pay them money and it goes away. So it's just a really fascinating area. What should the insurance cover? Should it cover the ransom payment? Or should it cover the costs to do the restoration back to your last restore point and try and figure out, what's missing? It's a fascinating area, and the insurers are trying to figure out how to cover it as well, especially because it lends itself to insurance fraud. Because you've got insiders that if they know this coverage exists and they know that the insurer will pay the ransom when requested, then you've got the issue of kind of insider extortion. I say that they're kind of honorable. In fact, we had one situation where a client paid and then they were kind of put on a reference list. They got contacted by somebody else that said, hey, we're going through this event. He said, he gave me your name and said you'd vouch for the fact that if I pay the ransom, that nothing bad will happen. So, who knows? Who knows, honor among thieves, I guess. What I always like to say about this too is when we're talking about these kind of things, think in terms of loss, not cause. Because the losses are obvious. It's easy to define the loss you want to cover. It's I want to be reimbursed for the cost of having to remanufacture this data, or the cost of having to, re-engineer my system. What's really hard to articulate is the cause. The cause changes so quickly that the insurance policies can't keep up with them. And there are policies that speak in terms of loss, and there are policies that speak in terms of cause. And sometimes folks get greater kind of a sense of peace from the cause-based policies because they can say, well, this is what I was worried about, this happening, this type of intrusion. But it's the next intrusion, it's the one you don't know about that really, ends up being, the risk, the business event. And so instead you want ones that talk in terms of loss. They say, we're going to cover these costs in the event that you incur them, and then there'll be things like, unless it's intentional, kind of stuff that would keep you from, using this to just buy yourself a new system. But that's the key in these first-party coverages. Loss, not cause. Last one I'll talk about, just because it's probably the most common right now. You don't see it as much as the data breach stuff, mostly because companies don't like to talk about it. But we're seeing tons and tons of funds transfer fraud. This is just foreign wires going out of corporate bank accounts. Day after day, big companies, small companies, as little as $5,000. We've had seven-figure ones. And this is an example. I like to use this also as an example because it's another place where understanding the risks and kind of keeping abreast as to what the newest and best is, and what the bad guys are doing can help you get a better insurance policy. So this is what the standard kind of computer fraud and funds transfer fraud language looks like. And if you look at number 2 there's something in quotes that says fraudulent instruction. And the idea is, if a bank receives a, quote, fraudulent instruction that causes money to go out of your account. Because that's the way it used to be. It used to be people would, you'd have a bank account where you could initiate a wire with letterhead or a fake signature, or maybe just a simple set of credentials, and those were compromised, and they were able to pretend to be you and give a fraudulent instruction. That's pretty rare now, because just the kind of layered security programs that banks have and multi-factor authentication, it's really difficult, and banks are really dubious, especially once amounts get above, say, $10,000, about wire transfers going out. They're very careful in authenticating the user. So what the new game is in funds transfer fraud is, it's kind of this business email compromise. They get into your email system, and they end up reading months and months of emails until they can craft really, really convincing and effective impersonation of people that have the authority to say to the CFO, to say to somebody in finance, I need you to initiate a wire transfer. Because they can look and they can see what your practice and procedures are. They can see that Susie in accounting gets instructions from Jane, the CFO, to wire money, and they can mimic it perfectly. And so it's no longer a fraudulent instruction, because Susie in finance, she was authorized to make it, and she was Susie when she did it. It's just that she was tricked into doing it. And so, but that's not covered by this. So what there's kind of these gap fillers. They're called endorsements. And so now this is a perfect example. If you know the risk, you say to your insurance company, that's not really the type of funds transfer fraud I'm worried about. So this one, for instance, I think this is from Chubb, which is an insurance company out of California. And this one is, they call this their social engineering endorsement. And it adds this idea of, hey, what about when it's an authentic instruction, but it's just been induced by some kind of social engineering, like these business email compromise. And like I said, you don't hear about them a lot. They're embarrassing. So companies don't like to talk about them. And most companies, you're not going to be able to steal $20 million, because as you get to higher numbers, the protocols get higher on the bank side. They want to talk to somebody on the phone, that kind of thing. But for small businesses, they're really material. And for big businesses, it might be in 7 figures, but it's not something they're going to publicize, because frankly, it's embarrassing. It looks like they lack their own institutional controls. So, now that we kind of have that framework there, and I know I'm running out of time here, so I'll speed up a little bit and just kind of talk through these underwriting problems, because I think this is kind of the bigger picture, right? This is what's the future of this market look like. There's an underwriting problem in that the supply side of insurance are insurers who are risk averse. They don't want to find out that something could get jammed into one of the coverage that they weren't anticipating. So they want to know what they're covering. If they don't know what they're covering, if they feel like they have gaps, their solution is to raise premiums. On the other side, you've got the demand side, which although it's ultimately organizations and businesses, it goes through agents and brokers. And an agent and broker is also risk averse, because you know who gets blamed when a company has an event and it turns out there's no insurance for it? They go back to their agent and they say, why didn't you tell me I needed that? So you've got agents who want clients to buy everything because it's the only way to keep them safe. And then you've got insurance companies that are jacking up premiums because they're so worried. They don't have actuarial data. They don't know what the next risk is going to look like and what it's going to cost. And so you've got these skyrocketing premiums and lowering limits. And so there's kind of this crisis where everyone knows they have to have it, but it's becoming increasingly expensive to procure, and it's becoming increasingly difficult to procure the limits that you need to kind of be an effective risk mitigator for your business. Part of that, I mentioned a minute ago, is this idea of information asymmetry. There is no actuarial data. An insurance company tell you with incredible certainty how likely it is that your warehouse is going to burn down in the next 10 years. They study this stuff. The actuarial tables are incredible. They're very good at doing it, and they price their policies that way. They just don't have the actuarial data here. They just don't know how to rate you. Again, it's easy to say a pizza parlor is more likely to burn down than some other type of business, or a rubber factory is going to catch fire, but somebody that, I don't think of something that isn't flammable, isn't. And they're able to rate folks and say this is their risk, and they're very good at it. How do you rate people in this? I mean, are you going to go in and are you going to audit them? Are you going to just ask a bunch of questions on an application? How good of a picture is that going to be? You'll find that every company we've ever dealt with tells us they have the best IT guy and the best information security guy there is, because they don't know any better, because the person telling them that is the guy who they're holding out as the best. So there's this difficulty in asymmetry of information. Again, this leads to higher premiums, lower limits. The third issue that's causing problems is the idea of correlated losses. A good example of a correlated loss is a hurricane. You have homeowners insurance. They know house is going to burn down. This house is going to get robbed, and that's kind of random, and they're pretty good at that. A correlated loss is a hurricane. If you're insuring a bunch of people in Miami, pretty much everybody in that market is going to have a loss at the same time. Insurance companies don't like that. They like to spread losses out. They like to smooth. And so they don't like hurricanes, and so it's unavoidable, but the way they avoid correlated losses in the homeowners world is if they're selling policies that cover that type of loss, they're going to sell some in Florida, they're going to sell some in San Diego, they're going to sell some in Maine, so that one hurricane doesn't infect their entire portfolio. That nobody knows what the kind of cyber hurricane is going to look like. And there's concepts that you guys understand way better than I do about connected nodes, and as far as I understand, pretty much everyone's running on Amazon Web Services these days, and so there's this idea of, is there going to be this event that they can't uncorrelate, that the event that affects every single insured, a business interruption that goes across their portfolio, and that scares them to death because they don't know how to deal with it. And so what are the solutions to that? One is the government solution. So TRIA, I don't know if any of you guys have ever heard of it. It's the Terrorism Risk Insurance Act. And this was a result of September 11th. September 11th was a disaster for insurance companies. It was a way bigger risk than they knew they were undertaking. Nobody thought that type of event was possible. And there was a lot of correlated losses. And so what happened in the wake of September 11th, terrorism was written out of first-party property policies. You just couldn't get coverage for it. And so the government stepped in, and they started acting as a reinsurer. They said, hey, insurance companies, you know what, we'll reinsure 80 cents on the dollar if you start selling terrorism insurance again. And so that was the solution there. And so there's a professor at Butler who his big thing is, this is where we have to go with cyber insurance, is there's got to be some government intervention to kind of push premiums back down, and that intervention is maybe, offering reinsurance for the catastrophic event, after a certain threshold at a certain percentage. The problem with that is the lack of uniformity. even the government wants to make sure that it's reinsuring the same thing for AIG that it's reinsuring for travelers. And so there's this push right now between insurance commissioners, insurance policies, insurance companies to kind of create some uniformity. But it's proving incredibly difficult because competition wins out above cooperation. And so, you know, the insurance commissioners around the country, they're trying to get carriers to share actuarial data. Hey, we'll have a bigger pot of information. If you tell us what's happening with your insurance, we'll tell you what's happening with ours. But of course, it's one of these things where nobody wants to blink first. Because everyone thinks that maybe they've got the secret formula and that their next issuance, the next round of policies they issue is going to solve the problem and they're going to be the leader in the marketplace. So, but this is where it's going to have to go. There's going to have to be some uniformity that creates expectations and that gives people what really I think everyone wants, which is I want to buy insurance for these events that I understand what they cover and how they cover it. I don't want this to be a guessing game. I don't want this to be an exercise in where a comma is in a sentence. I want to tell you what my expectations are, and I want you to cover it. And like I said, I know I'm running out of time, so I'll stop there. But is there any questions or anybody? Yeah.
So you say that, you know, something that they're actively trying to figure out, are they sitting in a room thinking about it, looking at historical data, or is it more of, we'll try this, see how it works out, and then pivot from there? And
When you
where's the
say
balance?
they, you mean the insurance
Yeah,
companies?
yeah.
Yeah, I mean they've got more data now than they did say 4 years ago, but it's a work in progress. I mean, they're getting a little bit better about rating this. What some insurance companies are actually looking at right now is actually kind of developing or acquiring their own security platform and pushing those to insureds and giving people discounts for, hey, if you take this company and pass, you know, it's an independent company that we've acquired, we want you to use their security platform. But then, of course, the insurance company can monitor, you know, that you're actually using it. You know, that's one solution. But yeah, they're trying everything. There's just, it's difficult because it's difficult to define the next risk, and that's the scary part for them. You know?
Yeah.
All right, well, thank you guys, and it was a pleasure. Thanks for having me.